Joining us right now to talk about the big bank earnings that are all coming out tomorrow, Jason Goldberg. He is Barclays senior equity analyst. And Jason, before we do, let's just talk about Citi with this news that came out. The charges are going to be higher than you were told December 6th. What do you think?
Yeah, no, certainly. Listen, it's a big company going through a pretty massive restructuring. And certainly there's going to be bumps along the way. And I think this is indicative of that. I think it's also shows that, typically fourth quarter earnings for banks are messy. And if you look of the top 20 banks, half have already pre-announced charges that are going to bring results, and we could see additional ones. And on top of that, the group, at least the top 20 banks this quarter, are paying $13.5 billion to cover the losses tied to the failures of Silicon Valley and Signature Bank last year. So it's going to be messy. Citi, it's a $2+ trillion bank, kind of going through a big restructuring, and there's going to be some little bumps along the way.
Overall, we are thinking, at least if you look at the expectations from the street, that numbers will improve. We'll see a bit of improvement in the earnings bottom line for these companies, but by less than we had thought maybe a month ago.
Yeah, listen, for the group overall, the fourth quarter is kind of being impacted by the continued increase we've seen in funding costs really throughout the course of 2023. Typically funding costs tend to peak 2 to 3 quarters after the Fed stops. So we're, getting closer to that point, but not just there yet. Additionally, fourth quarter, you tend to see, reserve building to kind of get ahead of loan losses that are expected for the year ahead. So you can see some of that also weighing on results. We have seen financial stocks in general pick up, though. Is that the right move? Yeah, no, certainly. It's interesting. If you look at, bank stocks, the last 2 months of the year rallied like 35%. Market was up closer to 15%. Yet, despite that, 2023 was the third worst year of relative bank stock performance in the last 90, with only 1990 and 2020 worse. So despite the fact that they bounced a lot, if you look at relative valuations, they're trading at half the S&P 500 multiple versus 3/4 historically. So we do think there's some room for that, relative valuation gap to continue to narrow, against the backdrop of the soft landing and the Fed switching from aggressive tightening to modestly easing.
Tomorrow we get 4 big banks. You got J.P. Morgan, you've got Bank of America, Citigroup, and Wells Fargo. Let's go through them one by one. First of all, which one's your favorite?
Yeah, of the big 4 reporting tomorrow, I would say J.P. Morgan is certainly the best athlete of the bunch. They were probably the biggest beneficiary of the turmoil last year, picking up First Republic, in addition to continue to take market share across all the main businesses.
And then let's say Bank of America. What are your expectations there, and what are you going to be looking for in terms of what they report?
Certainly with respect to Bank of America, from a net interest income perspective, they have lagged peers over the last several quarters. So that is something I think the street's paying particular attention to. Expenses have come down the last couple of quarters. I think there's expectation that should continue. And then credit quality for the generally loan losses continue to grind higher, albeit at a measured clip.
What do you want to hear just in terms of the treasuries that they loaded up on when rates were a lot lower?
Yeah, no, certainly, they had, the largest unrealized loss in their bond portfolio, results reported in the third quarter. We do expect that to decline for them and others. But they do have a fair amount of, low-yielding fixed-rate assets on their balance sheet that they're going to have to contend with against the current interest rate backdrop.
What about Wells Fargo?
Yeah, Wells, I think continues to make progress. Their net interest income has kind of outperformed the other, certainly Bank of America over the last year or so. They're still kind of dealing with some of their consent orders from several years ago. We look for continued progress there, and there's still a lot of room for them to have on expenses. Just given if you look at their efficiency ratio or cost-to-income ratio relative to a J.P. Morgan or Bank of America, still underperforming there by a fair amount.
Which of these 4 banks would you buy? Which would you hold? Which would you sell?
Yeah, of the big 4, I would say, we're kind of constructive on the group in general. As I said, noted, J.P. Morgan's probably the standout. And I think, you look at the announcement last night, shows how Citigroup still has a fair amount of work to do in their, recent restructuring announcements.